Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today we've got three major stories for you. First up, we'll explore how Ethereum, the now $420 billion platform, is quietly becoming Wall Street's new plumbing. But, as we'll see, its co-founder Vitalik Buterin fears that this very adoption by giants like BlackRock could threaten its core mission. Then, we'll shift gears to an icon of old-school finance, Warren Buffett. We'll break down why his firm, Berkshire Hathaway, just wrote down its Kraft Heinz stake again, and what its massive $344 billion cash pile is signaling to the rest of the market. And finally, we'll unpack a bombshell revision from the Bureau of Labor Statistics. It turns out the economy created far fewer jobs than reported, and corporate AI adoption might be the real culprit. Let's start with a single statistic that might just change your entire perspective on this. Last year, a new financial system moved $28 trillion. That's more than MasterCard and Visa combined. And it's all running on rails built by a project that started just 10 years ago in a drafty Berlin loft. So what are these rails exactly? We're talking about smart contracts. You can think of them as self-executing agreements written in code. They automatically move assets and enforce rules without needing a traditional middleman like a bank or a clearinghouse, which is what makes the whole system so powerful. That project is Ethereum, and it's quietly becoming the invisible backbone of Wall Street. Once a cypherpunk experiment, Ethereum is now a $420 billion platform. Major institutions are racing to plug into it. Deutsche Bank is building a tokenization platform on its network. BlackRock launched a money market fund on it. Robinhood is rolling out tokenized US equities. As one global blockchain leader at EY put it, what's happening now is that Ethereum is getting plumbed into this infrastructure. But what's often overlooked in this gold rush is a massive legal grey area. If Ethereum is the new plumbing for Wall Street, who is legally and financially responsible when a pipe breaks? Because the network is decentralized and pseudonymous, there's no single company to sue if a bug in the code leads to millions in losses. We saw this back in 2016 with the infamous DAO hack, where a coding flaw led to a $50 million loss with no clear legal recourse. This is the risk these giant institutions are now grappling with. The irony is staggering. A technology born from an anti-establishment ethos is now being adopted by the very system it sought to bypass. Even its co-founder, Vitalik Buterin, admits the growth has gone beyond pretty much anyone's expectations. This rapid adoption is, unsurprisingly, stress testing Ethereum's core values. For instance, the network's recent shift to a more energy-efficient system called Proof of Stake has introduced new risks. Buterin himself has warned that the way this new system works could allow a few large players to gain outsized control, which is the exact opposite of the decentralized dream. And with this mainstream adoption comes a critical warning from Buterin himself. He fears a future where Ethereum appears open, but in practice, a few powerful companies control the ecosystem. In his words, that's the thing that we don't want. This sets up the ultimate conflict. Can Ethereum scale to become the plumbing for the global economy without losing its decentralized soul? This all boils down to a fundamental challenge. Ethereum is a decade-old system. Think of it like trying to upgrade a jumbo jet while it's in mid-flight, carrying $400 billion in cargo. It's incredibly complex. Newer blockchains have been built for massive scale, but Ethereum has the momentum and the market's trust. The question is whether its technical baggage will hold it back. The answer may not come with a bang. As Buterin explains, this kind of disruption doesn't feel like overturning the old system. It feels like building a new thing that just keeps growing until one day people realize they don't even have to look at the old thing anymore. The real question is, are we already there? Speaking of old systems, one of the biggest legends in finance is facing a major test of his own. Warren Buffett's Berkshire Hathaway just saw its net income plummet an astonishing 59%, driven by a massive $3.76 billion write-down on its Kraft Heinz stake, a direct acknowledgement that a decade-old investment hasn't worked out. Now, this isn't just about one bad food company. Actually, this write-down strikes at the very heart of Warren Buffett's famous economic moat philosophy. For decades, he invested in companies with durable competitive advantages. But the Kraft Heinz failure shows that in today's world, that moat is getting easier to cross as consumer tastes change rapidly. What was once a fortress is now struggling to stay relevant. Believe it or not, this is the second time Berkshire has been forced to write down the struggling food giant. This is where the situation takes a more complex turn, because the conglomerate is now sitting on a near record cash pile of $344.1 billion. However, if you zoom out, you'll see another layer of strategy at play with that cash. It's not just sitting there by accident. It's a deliberate move. By holding onto this massive war chest and selling more stocks than they buy, Buffett is sending a clear signal. He believes the market is overvalued and is patiently waiting for a correction. It's his classic philosophy in action: be fearful when others are greedy. For 11 consecutive quarters, they've sold more stocks than they've bought, signaling extreme caution. One analyst put it bluntly, Buffett definitely views the market as overvalued and will sit back and wait for something to come to him. The headwinds are real, and they are hitting even the most popular brands. Revenue from Jazzwares, the maker of the viral Squishmallows plush toys, fell a shocking 38.5% in the first half of the year. This all comes as the company faces its biggest challenge: a future without its iconic leader. Since Warren Buffett announced he would step down as chief executive, Berkshire's stock has fallen more than 12%, lagging the S&P 500 by about 22 percentage points. This gets to the heart of what analysts call the Buffett premium, the extra value investors assigned to Berkshire stock, simply because Buffett was at the helm. It's a premium based on his reputation and legendary market timing. The big question now is whether his successor, Greg Abel, can maintain that confidence. Abel is a proven operational leader, but the market hasn't seen his track record on massive capital allocation decisions, which was Buffett's true superpower. As another analyst warns, Berkshire and the economy are at an inflection point. I don't think the market will embrace the combination of mediocre results, a lack of stock buybacks, and Berkshire's recent share underperformance amid a management transition. With the legendary investor preparing his exit and the company hoarding cash, the question isn't just about one bad quarter, it's about what happens to the $1 trillion empire when the legend is gone. Buffett's caution seems especially prescient when you look at the latest US job market data, which just got hit with a bombshell revision. It turns out the economy created 258,000 fewer jobs than we were told over the last 2 months. So how can the government be off by over 250,000 jobs? Well, the reality is that the Bureau of Labor Statistics, or BLS, uses survey models that are struggling to keep up. Our economy is changing so fast with gig work and remote jobs that the BLS's birth-death model, which guesses how many businesses were created or closed, can be way off. When that happens, the revisions are massive, just like what we're seeing now. One chief economist is now saying, quote, "We're finally in the eye of the hurricane." After months of supposed resilience, the new data tells a completely different story. The BLS just dropped a statistical bomb, revising May's job growth down from 144,000 to just 19,000. June's numbers were even worse, plummeting from an initial 147,000 jobs down to a mere 14,000. And what really brought this to a head was the brand new number for July, which shows employers added just 73,000 jobs. That's below the level needed to keep up with population growth, meaning the job market is now officially contracting. The average job growth over the past 3 months is a paltry 35,000, a steep drop from the 111,000 average seen at the start of the year. This isn't about mass layoffs, which remain low. It's about something else entirely. The national hiring rate is near its lowest point since 2014. Experts are calling it a high degree of stagnation, a trap for anyone looking for work. So, what's causing this strange paralysis? Interestingly enough, many experts believe we're seeing the first major effects of corporate AI adoption. The theory is that companies are using AI to make current employees more productive. This means they don't need to hire new people to grow, but the tech isn't advanced enough yet to trigger huge layoffs. The result is this exact situation, a hiring freeze without a firing spree. In fact, a recent Gartner report found that 45% of companies are already restructuring their workforce because of new AI tools. The unemployment rate has ticked up to 4.2%. But the most concerning part might be this. The share of Americans who are long-term unemployed out of work for more than 6 months has now climbed to nearly 25%. The slowdown isn't just a number, it's locking more people out of the workforce. And the crux of the problem is that the jobs that are being created are concentrated in very specific areas. We're seeing a huge divergence. While tech and finance are stagnating, nearly all the recent job growth is in sectors like healthcare and social assistance, driven by forces like our aging population. The issue is these jobs require a different skill set. A coder can't just walk into a nursing role. This mismatch is a huge part of why so many people are struggling to find new positions, creating this growing group of long-term unemployed.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.